Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Jason Del Vicario, Portfolio Manager at Hillside Wealth Management with IA Private Wealth, will be joining us for the hour. In 30 minutes, we'll get the latest numbers for Canada's inflation in March. Pedro Antunes, Chief Economist at Signal 49 Research, will help us digest the data. And of course, we want to hear from you this morning on First Call. Call us with your questions on global growth stocks, and we'll have Jason answer as many of them as he can. At the end of the show, the number 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address is firstcall@bellmedia.ca. Now, some of the stories we're following for you in the BNN Bloomberg newsroom. Agnico Eagle is expanding in Finland with 3 deals valued at about $3.7 billion. The company will buy Rupert Resources in a deal with $2.9 billion, offering Agnico shares plus up to $3 per share in contingent payments. Agnico is also acquiring Orion Resources as well as B2 Gold's stake in the Fingold joint venture for more than $300 million. Bombardier has landed a new services deal with Vista worth about $300 million over 5 years. The agreement covers Bombardier's smart parts program for Vista's Challenger 3500 aircraft, a part of its existing fleet. The deal provides a cost per flight hour structure and includes coverage for major components, avionics, and maintenance items. Ottawa's temporary suspension of some fuel taxes kicks in today, with Canadians likely to save 10 cents a litre on regular, 4 cents on diesel. Last week, Prime Minister Carney announced a pause on those fuel excise taxes up until Labor Day. The Liberals say this is a prudent way to tame prices at the pump at a cost of more than $2 billion. And now our top line story. Oil is surging again, up more than 5.5% right now. Markets are trending down into negative territory after a turbulent weekend in the Middle East cast doubt on the prospects for peace talks. Iran halting traffic through the waterway, the U.S. seizing an Iranian ship, dimming hopes of a breakthrough in efforts to end the war. We'll see now what it means for investors. And let's bring in our guest for the hour, Jason Del Vicario, Portfolio Manager at Hillside Wealth Management with IA Private Wealth. Jason, thank you for joining us. Just another interesting day in the Strait of Hormuz. What a weekend. Your thoughts on it?
Certainly. I mean, this is almost really the new normal, isn't it? We see talk of ceasefire, then we see either side, dispelling or.
Oh, we are having
it's extremely difficult to be making any decisions based on these short-term actions. I find it very...
Sorry, Jason, we lost you.
Very fast-moving, very difficult to make any sort of actions, at least in terms of how we allocate capital here in the short term.
Okay. Sorry, Jason, we had a little technical difficulty. We lost the first part of what you were saying there. If you could just repeat that. Okay, I think we're having some more technical difficulties. I think we'll take a break right now, take a look at the markets before the bell, and we'll get Jason all straightened out. We'll be back after this break. Let's see how things are shaping up on the markets. We'll start now with U.S. futures. And you can see they're a little nervous about what's unfolding in the Middle East right now. Off by right around 0.45% all three of them after closing at seeing a few record highs on Friday for the S&P 500, NASDAQ as well. So pull back from that a little bit. And Asian markets, they seem to have some more confidence about what's unfolding in the Middle East. They were up for the day. Nikkei up by 0.6, the Hang Seng by 0.77, and the CSI 300 by 0.61. And heading to Europe, they're more in line with the U.S. right now. You can see FTSE off by 0.66, the CAC Quarante by little over 1%, and the German DAX 1.3%. And what about the TSX? It finished up not quite at a record, but pretty close, pushing up back that way again, up by 0.86% to finish above 34,300. Consumer discretionary, that index was leading the way, along with tech. Going the other way, energy dropped by 2.64% on Friday. And some of the movers and shakers from the day. Avino, silver and gold up almost 8%. Nova Gold about the same. On the other way, Canadian Natural Resources up by 7.24%, and Vermilion down by nearly 8%. And taking a look at gold, it's gone the other way. It was up in the green briefly earlier, but now you can see it's off by about a point. Silver futures up above 80, but still down right now by more than 2.5%. And copper is also up by 1.2% at $6.10. Western Canadian Select, we saw that correction on Friday. It was down more than 10% to 64.94. Now, WTI today is reacting the other way because of all the news that's unfolded over the weekend. In the straight, it's up more than 5% at 88.31. Okay, hopefully we have all the technical issues resolved. We're going to bring Jason back in to discuss what investors should be thinking about in this volatile environment. I think that sums it up nicely. Volatile is the word. Jason, I was looking at the markets. It's interesting. We saw Asia, they're all in the green today. Europe, though, and the futures here going the other way.
Yeah, I think this really speaks to maybe the market getting a bit fatigued in terms of all the changes of direction. I mean, it seems to be changing from day to day. And perhaps the market's looking through towards, the Q1 earnings season that's coming up, which is expected to be quite strong. We've seen a big rebound in areas that had been beaten down, like software stocks and what have you. So, I think it's difficult to pin short-term movement to geopolitical events at this moment, especially when it just seems to be changing so quickly.
And is that a dangerous game to play, or can the market survive playing it that way?
Well, I mean, sure. I mean, there are day traders out there. I don't know too many people that can do that consistently well and successfully. I think that's if you want to play that game, that short-term game of having positions open for hours or minutes. I'm of the personal belief that is a zero-sum game. That access to news, access to data feeds, the quickest and most efficient maybe have an edge there. But I think the better news is for people who have money saving for for retirement or for education. They should be looking 3, 5, 10 years down the road and holding companies that they deem to be high quality. And it's during times like this where you have economic uncertainty or political uncertainty, where the very best companies in the world can actually gain market share. They can make strategic M&A decisions because all things being equal, will be available at reasonable prices. And they can also be on their front feet. So I think that should be the focus of Canadian investors, especially during this tumultuous period.
And what are you looking at? Where are you looking right now?
Yeah, so the types of investments we look for, I've been on BNN a number of times, and we talk about the selection criteria. The first that we look for is companies that are founder-run, founder-owned. So we think that it's very important for the companies that people are invested in, that they're invested alongside the people running the businesses, the board members running the businesses. as opposed to hiring a professional management team. So there's a lot of evidence pointing to founder-run, founder-led companies outperforming indices over the long term. And then, of course, the number one metric that is really the most important when investing in a business, whether it's a business, private business, public business, even a rental property, is your return on invested capital. And so we look for companies that have posted consistently above average returns on invested capital. And we find that those areas are strong areas of focus for long-term investors.
All right, and one of the things that's been dominating the conversation when it comes to the markets, AI, and where it's going to take us. Companies are starting to incorporate it, but also the death of software. I use air quotes for that.
Yeah, so there's a lot of noise in the marketplace right now. If we step aside from geopolitics, which I guess is probably louder noise these days, AI's impact on the economy, AI's impact on software in general. There's a lot to unpack there, but some of the companies that we've invested in, we've seen their stock prices down dramatically over the past year. I'll just throw out Constellation Software as an example. Paycom is another example. Even Meta has wobbled of late, but given the amount of money that they're investing in AI. And the narrative out there is that AI is going to kill software. We seemingly weekly have announcements from the likes of Anthropic or OpenAI, sort of disclosing revolutionary advances in terms of their LLMs and the impact on software developers. And I think it's important to understand what software is, because I think many of these announcements and many of the investors can be very focused on just the code, so the algorithm. Mm-hmm. I think it's accepted that it would be very easy for, let's say, you and I now with the LLMs to vibe code a replacement to Reddit or a replacement to Salesforce, some of these horizontal market software companies, or even some of these vertical market software companies. We could probably use AI to code a booking system for golf courses. These aren't that complicated in terms of the actual code that goes into writing the software. But software is much more than just the code. You've got the customer data. You've got the switching costs, so the ability for these customers of software companies to use the software, the people, at the golf courses, managing the golf course, just to use the golf course example. Mm-hmm. Then you've got regulation. So for example, in my industry, in the financial services industry, any software that's used, it's got the customer data, there's privacy concerns, there's regulatory concerns, there's concerns in being able to link software to, let's say, data feeds, trade desks, et cetera, et cetera. So it's not quite so simple to just simply think that, okay, because we can write the code, or we have a machine now that can write the code for us, that we will therefore be able to successfully displace an incumbent software company. We think rather that existing software companies will use AI as a tool, as an evolution or a generation from the very first models for coding, which was using zeros and ones, and then it became a simple language, and then a more complex language like C++. And we think that AI is a evolution, not necessarily a revolution, to the way that software is developed and maintained.
And it feels like these are companies that they've been at the forefront for a long time, and they are looking at the things that may impact their company and impact their business. So it's not like they're surprised by this, are they?
No, and that's a good point. The Constellation Software, for example, held a call on the impacts of AI on their business in September of 2025. And I've read that they've been using AI or a form of AI since 2016 in their businesses. And I thought the call that they hosted, which of course is available on their website for anybody to hear, was very honest and truthful. The market didn't like it, but they basically said, listen, at this point, we don't know if AI is a tailwind or a headwind. And they laid out some examples as to how it could be either, but that they don't have their heads in the sand, that they're rolling out AI to the various businesses. As many know, they've acquired 1,200 vertical market software companies. And they're using AI with their customers, looking to improve productivity, at least on the software development side, but also productivity for the customers. And I think that the incumbent software companies are really in the driver's seat. If anything, it's it's their war to lose, if we want to use some sort of geopolitical analogy. And we think that they're in the best position to be able to incorporate this new evolution of abilities and be able to roll that out to, and let's not discount these customers. They've had relationships with these customers for 5 years, 10 years, 20 years. They go back and forth in terms of maintenance issues, bugs, upgrades, customization. And so we think that, as you said, they're in the driver's seat to be able to roll this out to their customers. And frankly, in terms of the data that's coming in, that's what we're seeing so far.
All right, we've got to wrap it up, take a break there. But next up we'll see what's on the radar for Jason Del Vicario. And guess what? It's Constellation Software. We'll talk a little bit more about that and a couple other stocks after the break. Prime Minister Mark Carney posted a YouTube video over the weekend. His address covered U.S. relations and forward guidance, but the message didn't land with certain conservatives. CTV's Graham Richardson has this report.
It's a direct address to Canadians shot at a home in suburban Ottawa, with Mark Carney spending a lot of time on how the United States has turned away from free trade and what that means for Canada.
Many of our former strengths, based on our close ties to America, have become our weaknesses, weaknesses that we must correct. The U.S. has changed, and we must respond.
Pictures of his China and India trips front and center, suggestions that conservatives are too optimistic about changes in America.
There are some who say there's no need for a comprehensive plan. They believe we should wait it out in the hope that the United States will return to normal, that the good old days will come back.
Conservatives dismissed all of this as more of the same.
A family filling up a grocery cart in Saskatoon doesn't need Mark Carney's economic philosophy. They need the bill at the checkout to stop going up.
Carney talks about history here, too, and how Canadians have beat back American aggression before. Featuring a small statue of Isaac Brock, he says he keeps in his office a gift from Mike Myers.
Brock was a hero who fought and gave his life for our forebears in the War of 1812.
This address was not designed for a soft, comforting message.
There was an effort to offer people reassurance in this message, but much of it was stark. Much of it was meant to drive home how severe the challenge that we are confronting truly is.
This all comes at a tense time for Canada-U.S. relations. The Americans are moving forward with formal free trade talks with Mexico. That hasn't happened for Canada yet. And if this address was designed to land with Canadians, the government will be watching very closely to see how it lands with Donald Trump. Graham Richardson, CTV News, Ottawa.
And let's see what's on the radar now for Jason Del Vicario from Hillside Wealth Management. Constellation is popping up. We were talking about it before the break. Let's get into a little more of what you're liking about it right now.
Well, I mean, operationally as a company, they're a fantastic company, but they have generally been quite overvalued, at least in our opinion, over the past number of years. But with the SaaS apocalypse, software companies or SaaS companies being taken out back, the valuation has become much more attractive. We put it in sort of the low 20s range in terms of their cash earnings. And so we think for this quality of company that the valuation is compelling, especially for those who may have been on the sidelines watching it sort of relentlessly go up prior to 2025.
And Constellation is a name that pops up, and I'll ask this question. It's a company, it buys software companies. Could we see it pivot to start buying something different?
Yeah, that's a great question. So in 2021, Mark Leonard, who's the founder and ex-CEO of Constellation Software, mentioned that if it became increasingly difficult for them to allocate capital into VMS companies, that they would perhaps have to pivot. So we haven't seen that yet, although we have seen them change in their last quarterly earnings release. They talk about the PEM strategy, where they're looking at investing minority stakes in public equities. So this is a little bit new for them, but they're still very much in the VMS space. My understanding is, I think in 2021, 2022, they took a swing at an oil company, oil software related company, but weren't successful. So they certainly have their feelers out beyond VMS software. Yes.
All right, let's pivot now, and I mean really pivot. Games Workshop is another stock you're liking right now. I didn't expect that. I was looking it up. I'm like, oh, they make some cool figurines.
Yeah, so they almost have a cult-like following. It's a hobby really that has many levels. So the original game of Games Workshop is these plastic figurines that hobbyists will buy. They'll paint them. It's a tabletop game, not unlike Dungeons and Dragons, is my understanding. But then the IP, so the intellectual property of Games Workshop, that whole Warhammer lore, has been used in video games, books. There's a deal right now with Amazon to bring it to the big screen. So this is a very, very interesting company because they really don't have any direct competitor. And if we think about sort of barriers to entry and pricing power and things that really identify moats of companies, it's a very, very strongly moated company based in the UK.
Is that really trading at almost 20,000 pounds? So $42,000?
No, so when you see quotes in the UK, you need to knock 2 zeros off. So I believe it's actually 200 pounds. They'll show them, so it is 20,000 pennies. And that's how the quotes are in the UK. It's a little bit confusing, yeah.
And any concerns with this potential downturns? I mean, it's a bit of a luxury market, isn't it?
It's funny. So their primary customer tends to be men, young, sort of in the kind of 18 to 30 range. But it's interesting now because the company's been around since 1975. So we've seen evidence where the hobby is being passed now from father to son to even grandson. And we read something a number of years ago when we were initially doing research on the business that these people, these hobbyists, will literally spend their last dollar on a Games Workshop figurine or on the hobby rather than feeding themselves. So it is a very, very sticky hobby. But to your point, it is a luxury. And so we may see some people pulling back, but that certainly hasn't been the case. If you look at their quarterly data and annual data, it's from lower right to upper right.
Okay, let's get that last one in because I love going to junkyards. Copart.
Yes, so this is a business that we've recently invested in, and this is kind of a good example of the type of process that we use. This is a company we've been following for the better part of half a dozen years. As you said, it's in the very sexy salvage market, junkyard market. It's a 2-horse race, so we love companies where there's limited competition, as I was just mentioning with Games Workshop. So IAA and Copart occupy about 80% of the market, and it's a double-edged network. So IAA and Copart are taking vehicles that have been totaled. They're helping insurance companies get those off their books. And then interestingly, they have opened the world to these cars. So cars are increasingly being written off without being that severely damaged. And there's a huge market for these to be either rebuilt or taken as is, generally outside of North America. So it's a very, very interesting business. Price is down 50%. So again, the valuation is compelling.
All right, we got to wrap it up there, but stick around. We've got lots ahead, including breaking CPI data, and our phone lines will open soon for our first call segment. 1-855-326-6266. You can email us as well. First call at bellmedia.ca. We have breaking news for you now about our inflation figures. They are just coming in. And CPI year over year, the survey was at 2.6%, came in at 2.4. Core year over year, 2.3 is what was expected, and that's what we got. And core with the trim, 2.3 was expected, 2.2. And I think, what else have I got? I think I've got everything here. Let's bring in our guest here to help break it down a little better. He's the man that knows. He is Pedro Antunes, chief economist at Signal 49 Research. Pedro, thanks for joining us today.
You're welcome. It's always a pleasure.
Okay, when you're looking at these numbers, what do you think?
Well, I guess no surprise, because we know that in the month we had a 20% increase in March in oil prices and, well, in fact, in gasoline prices. And we know exactly what the weight of that is in the basket, about 3%. And so we knew that we were going to see a fairly strong tick up in inflation, despite the fact that the carbon tax removal is still in those numbers in March. So in April, we won't have that benefit. And we know that in April, gasoline prices are kind of averaging around 30% above where they were in February. So I'm afraid this unfortunately, we were looking for good news on Friday. That kind of turned around over the weekend with respect to the Strait of Hormuz and oil prices. So I think we're in for a run of inflation, not just in April, not just in March, but in April as well.
Jason, do you want to join it?
Yeah, I was just going to jump in. It's interesting from an allocating capital perspective as well as consumers' perspective. One has to wonder, how high do you think inflation, or how prolonged do you think this uptick in inflation would have to go before you think the Bank of Canada would move to raise rates? I think that's probably on a lot of people's minds here as we're all very nervous about what's going on.
Well, I think in their last announcement, the bank was really quite hawkish. In other words, they were, talking tough. I doubt we'll see an increase yet. The next announcement is coming at the end of this month and on the 29th. I don't think we'll see anything there yet. But the bank is worried because of what we lived through back in 2022. We had that inflation spike, essentially with the Russia's invasion of Ukraine. We had a major commodity price hike. And at the time, a lot of the central bankers were talking about base year effects, and this is temporary, but it got built into the wage numbers. And for 3 years, the Bank of Canada has been very concerned about essentially wages catching up with that. But can we get those wage inflation down? So the point here is that I think the bank is going to be very concerned. The other important point is that essentially the rates that you and I pay that are based on bond yields, they've already come up in expectation of tighter monetary policy. So we're already feeling the pinch of this inflation impact on essentially debt financing costs.
And you said they've come up with, will we see more raises as well? More increases?
Well, yeah, I don't think we'll see anything yet. I think the Bank of Canada, the economy is really weak, and it's tough for monetary policy when you have a supply shock, a supply price shock here at the same time that the economy is already quite weak. It's not a thing it's not a situation that monetary policy handles very well, because what can they do? They can increase rates to hit the economy even harder. But the point here is that this is coming from outside. It's an energy price shock. It's hitting in gasoline prices first. It will also translate into higher transportation costs, and that's when it starts spreading more broadly through the economy. So I think it's wait and see for now. We're all very hopeful that we'll have some resolution here and oil prices will come back down. But for the moment, I think central bankers are going to be very concerned.
Yeah, I think it's interesting. So in 2022, we thought that this, the Ukraine war would be, temporary. And here we are a few years into it. Now we've got the issue going on in the Middle East. I think it's, maybe we don't know what's going to happen. And I think that uncertainty is hurting Canadians. And then moving on to food, we all need to move and we all need to eat. How's food inflation looking from your perspective?
Well, in fact, that's one of the components of inflation that even in February still hadn't come up. I haven't seen the numbers here that we just released by StatsCan, but inflation on food had been running at around 4%. Yeah. And that was down from, really huge numbers prior
Pedro,
to that.
I can jump in and give you the numbers for this last month was 4.4%.
Oh, well, there we go. So that has not eased at all yet. And, the Strait of Hormuz, it's not just oil and natural gas. Well, in fact, natural gas plays a role in fertilizer costs. And we're already hearing from grain producers and farmers, and even in Canada here, we're a big producer of fertilizer, but it is a product that is international. So when the prices go up globally, they go up domestically. So it's not just the transport costs and how that's going to affect the supply chains broadly. broadly. But for food, I think we may end up with more pressure, and really that's unwanted. Again, food inflation is such an important part of what consumers have to purchase. There's just no moving away from it, and it's really hurtful to lower income households in particular.
And going back to the fuel for just a sec, the tax break we're getting, will that help, or is that kind of a drop in the bucket?
Well, I do think it'll help. What we've seen is about a 30-cent increase so far in gasoline prices. So the gas tax cut. There's two aspects to it. One is it gives back about 10 cents of that. So that's not. It will be noticed. It won't have an impact on this kind of transportation costs globally, and that concern around the supply chain impacts on products more broadly. But it will affect directly gasoline prices and what consumers are paying at the pump. So there's that piece. It's kind of giving back to consumers broadly, but it will also help lower that top line inflation. And it's top line inflation. Even though we talk about core and the bank is focused on core inflation, top line inflation is what consumers are looking at. It's what affects their purchasing power, and it's what is going to drive future wages. So in the sense that might take some pressure off of that top line inflation, at least temporarily, I think that's kind of it's perhaps a good policy move. I will say that it's very broad based, and it comes at a time when we're not really able to afford a lot of spending measures. But again, I just mentioned monetary policy is not very effective in this kind of situation. Perhaps a little fiscal policy could help.
All right, Pedro, we have to wrap it up there, but thank you as always for joining us.
It's a pleasure. Thanks for having me.
Pedro Antunes is chief economist at Signal 49 Research. Agnico Eagle is expanding in Finland with 3 deals valued at about $3.7 billion. The company will buy Rupert Resources in a deal worth about $2.9 billion, offering Agnico shares plus up to $3 per share in contingent payments. Agnico is also acquiring Orion Resources as well as B2Gold's stake in the Fingold joint venture for more than $300 million. Bombardier has landed a new services deal with Vista worth about $300 million. It's spread out over 5 years. The agreement covers Bombardier's smart parts program for Vista's Challenger 3500 aircraft and part of its existing fleet. The deal provides a cost per flight hour structure and includes coverage for major components, avionics, and maintenance items. Ottawa's temporary suspension of some fuel taxes kicks in today, with Canadians likely to save 10 cents per litre on regular gasoline and 4 cents on diesel. Last week, Prime Minister Carney announced a pause on those fuel excise taxes up until Labor Day. The Liberals say this is a prudent way to tame prices at the pumps at a cost of more than $2 billion. Still ahead, are real estate and commodities really the best way to protect your money from inflation, or are there smarter alternatives? We'll be back with Jason Del Vicario to get his insight into this. And of course, our phone lines are open. Jason will be taking your questions on global growth stocks. You can reach us at 1-855-326-6266. You can also email us, firstcall@bellmedia.ca. We're going to examine different ways investors try to protect their money during inflation, including how various assets and business models tend to perform when prices are rising. Let's bring back in Jason Del Vicario, portfolio manager at Hillside Wealth Management with IA Private Wealth. Jason, elaborate on this. Give us a little more about what people should be looking at and why.
Sure. So, on the theme of the inflation report today, as well as inflation being relatively high, at least since 2022, there's a lot of chatter in terms of the types of businesses that are best for investors during inflationary times. And we often hear that it's companies that are commodity-based companies, hard asset companies, real estate, which of course is a hard asset, are those businesses that are best suited to be able to withstand inflationary pressures. There's buried in the 1977 and 1981, which of course was the last time we had heightened inflation, these letters by Berkshire Hathaway's founder and CEO, Warren Buffett. He actually highlights that the companies, and he shows a mathematical example, companies that have pricing power and have a capital light business model are really the types of businesses that are best for investors during inflationary times.
And so what are you looking at when it comes to that very 1981? That was a long time ago.
Well,
Still applies, eh?
It absolutely applies. History doesn't rhyme, but it repeats itself. And here we are again in a heightened inflationary environment. So the company that we just talked about, Games Workshop, is a classic example of a business that has a scarce intangible asset. So their scarce intangible asset is that IP, intellectual property, the lore that the Warhammer 40K has given to hobbyists. And this business has a history of being able to increase their prices by about 3 to 5% a year. Companies, if you open any economics textbook, if you raise prices, that means all things being equal, demand and the amount that you sell should go down. But those businesses that have scarce intangible assets that really would manifest itself in terms of network effects or brands are able to increase their prices without having to invest a lot of capital into the business to maintain and grow the business. And that's the real key there, because that investment that you're spending on a business, if you're in a capital heavy business, when inflation raises prices for maybe a product or service, it also raises the inputs. So businesses that can raise prices and have lower inputs are really those that can thrive during inflationary environments.
And then going the other way, what are some of the things that you stay away from?
Yeah, so it might sound silly right now given that oil prices are up 20-30%, but oil and gas is a classic example of businesses that are capital intensive. So you have to spend a lot of money to find the oil and gas, then you have to spend a lot of money to get it out of the ground, permitting, regulations, et cetera, et cetera, et cetera. And at the end, you can model and try to predict what the oil or gas prices are, but you have no control over the pricing of your product when you then go take it to market. So, metals companies, even gold companies, if you look historically at their returns on invested capital, you see something that really mirrors the commodity price, which is more like a sort of an up and down signal, as opposed to one where the company is increasing their earnings steadily over time.
Is there any group with sector within that energy industry that you might look at, or no?
It's an interesting question. There is one. There are a few companies. So some of the software companies that provide services to the oil and gas industry can be interesting. Pason Systems, Computer Modeling Group. There's a royalty company in the States called Texas Pacific Land Corp. They don't actually produce the oil. They will license out their land to producers. That's a very, very capital light, high margin type of model. But they are few and far between in the sector that you noted.
And what about things like real estate?
Yeah, so real estate is interesting. Again, in inflationary, if we think about the inputs of real estate, if you're buying with cash, okay, fine. But most real estate investors are using some form of leverage. In an inflationary environment, again, we're talking about input costs or capital costs. Borrowing money is part of the input cost of holding real estate. And in an inflationary environment, those costs go up. The repairs to maintain a piece of property, those also go up. If you've had an electrician or a plumber at your home recently, they're charging anywhere from $60 to $100 an hour, whereas say 10 years ago those prices were, let's say, $30 or $40 an hour. So again, real estate does have they're not making new dirt. Maybe they're not making south-facing waterfront. There is some scarcity to it, but in terms of carrying real estate, we find that those are capital-intensive operations, and the costs do go up lockstep and barrel with the inflationary pressures.
All right, we've got to wrap it up there, Jason, but lots more still ahead. Next up, we'll take a look at some of the notable analyst calls and recommendations moving the markets. All right, let's take a look at some of the notable analyst calls and recommendations. Northland Securities is starting coverage of D-Wave with a market perform rating and a price target of US $22. The firm cites growing interest in quantum computing alongside ongoing questions around commercialization and near-term revenue. While D-Wave is viewed as an early mover in the space, Northland notes competition is increasing as larger players invest heavily in the technology. Overall, the firm sees potential over the long term, but believes risks and opportunities are currently balanced among the 5 quantum names on which the analysts launched coverage. It has outperform ratings on IonQ, quantum computing, and Xanadu Quantum, and assigns market perform ratings to D-Wave Quantum and Rigetti Computing. TD Securities raised the firm's price target on Celestica to $350 US from $330 and keeps a hold rating on the share. The firm expects the company to report a solid quarter, but says the stock's recent rally sets the bar higher. And when we come back, Jason will take your questions on First Call. Time now for First Call, so we'll head to the phones. And Sam from Ottawa, how are you, Sam?
Good morning. Thank you for taking my call, and good morning, Jason. My question regarding Brookfield Asset Management. With the Carney government getting majority, and just like you were talking inflation, they already own a lot of assets. And essentially, the stock is getting hot, and I think they'll get more contracts. Any thoughts on Brookfield Asset Management? And thanks for taking my call.
Sure. So Brookfield Asset Management has been a very, very strong long-term compounder of shareholder wealth. I would look through it through that lens. It's not a company that we follow because the insider ownership, we see that Bruce Flatt only owns about just a little under 1% of the stock. And so it's not the type of company that we would follow or own at Hillside. However, having said that, it's difficult to argue against their long-term track record. I'll sort of sidestep the answer in terms of what a liberal majority government would do to a Brookfield Asset Management. If you want to be an owner of a business like this, you're going to probably have a liberal government at some point in the next while, such as right now. You might have a different political party in the future. And so I think you really want to look at the fundamentals and the economics of the business. And as I said, they've done a very good job of increasing shareholder value over the long term. So I would focus on that rather than short-term political reasons for owning the company.
All right, let's grab an email now. This one is from Mike. Could I please get your guest's opinion on Microsoft?
So Microsoft is a company that we own. We've owned it for a number of years. The stock price has come off. It was arguably overvalued last summer at about 40 times earnings. We saw it come down to the low 20s. We think that anytime Microsoft gets into the low 20 range, that's probably a good valuation level, meaning that the forward rate of return is attractive. I won't go into the boring math of it all, but at 40 times earnings, you need a lot of very, very strong growth to be able to justify that valuation. So with the valuation down, earnings up during this time, we've seen the valuation come down about 50%. As we know, they have very, very strong business in terms of office software, as well as the cloud market. And we think that they have a leadership position in both of those areas, which should help them be able to continue to generate strong returns on capital. We do have some concerns, I would say, about the insider ownership. Satya, who's their CEO, has been there for 12 years. And I know it's difficult for insiders to own a large percentage of a $4 trillion company, but we really would like the operators, the doers of the business, if you will, to own a larger chunk. But, it's tough, again, to argue, just like with Brookfield, with Microsoft's long-term compounding of shareholder wealth.
All right, let's get a couple more emails in. This one's from Tim. It says, what are your thoughts for online casino developer evolution, possible AI disruption, market share, etc.?
This is a great question. So this is another business that we own. It's a relatively large position. I think it might be our number 5, number 6, around the same type of weighting as Microsoft. This is a Swedish-based company that dominates online casinos. They're really the white label for the MGMs and the land-based casinos, as well as the online casinos providing things like blackjack, roulette, and what have you. I think they have something like 70% market share, but they have been running into some headwinds, namely regulation, ring fencing in Europe. There's been some piracy issues in Asia, and they've even had some labor unrests at some of their studios in Georgia. Putting this all together, the valuation has come down dramatically. They were at sort of 60 to 80 times earnings when they were at around 1,600 Swedish kroner. They've come down. We were able to initiate a position at a favorable price and add to our position recently. They are founder-run. They're not founder-run, but they're founder-owned. They have very, very high margins, no debt, strong returns on invested capital, and so far we haven't seen, to the question, any market share losses. But this is something that we always track with any of the businesses that we own, and so we'll be keeping an eye on that. But we think at current levels, investors are certainly well paid to take on the various risks that I outlined for a company that has a dominant position in their industry.
All right, we're going to have to wrap it up there, but thank you as always for joining us, Jason. Appreciate it.
Thank you. Jason
Del Vicario, portfolio manager at Hillside Wealth Management with IA Private Wealth. Again, Andrew Bell's at Wealth. Easy for me to say today. Andrew Bell's up next with the Open. Trading gets underway about 30 minutes from now. We'll see what happens today. Have yourself a great day.